Hello everyone, welcome back to my channel. Today it's 2022, September the 24th, and right now it's 11 a.m. in the morning on the east coast of North America. It's the weekend again, so I'm gonna do this weekly recap and analysis in English again. And for those who are new to my channel, just be aware that most of the stuff on my channel is in Chinese. I usually do daily market recap in Chinese, but during the weekend I usually do the English recap and analysis. So let's begin talking about today's topics. So for today, I'll break down into 3 parts. So first, I'll talk about the probability of relief rally next week. I'll look at this from a quantitative point of view, and then I'll talk about the weekly technical analysis. And the last part is also, which is also the most interesting part, I'll talk about the bond market. I'll try to assess when the bond yields will top. Okay. Without further ado, let's begin today's topics. So first, the probability of relief rally next week. So if you are new to trading, one of the most common trading strategies you learn is to buy the dip or to try to play a bounce when the when the stock price goes under the lower bound, the lower bound of the daily Bollinger Band, and when the daily RSI is below 30 threshold. So right now, if you look at the S&P 500 daily chart, let me pull the chart out. If you look at the daily chart, sorry, the weekly, the daily chart. Let me change it to daily chart. So if you look at the daily chart, you'll see that it's already in the oversold threshold. In the oversold territory based on the RSI. And if you look at the daily Bollinger Band, it's also below the lower bound of the daily Bollinger Band. So usually for newbie traders, the first strategies they learn is the first counter trend strategies they usually do is to buy the dip when the close is below the lower bound Bollinger Band and when RSI is below 30, right? So I want to see historically what's the probability or what's the win rate of this strategy if we look at S&P 500's 5-day return in the next 5 days. So to look at this, I use Python, and let me show you the results. So from Python, I look at the results. I do the backtest. Quantitatively speaking, 65% of the time in the past, when this kind of setup showed up, usually 65% of the time, the return in the next 5 days is positive. So basically means you have 65% chance to win some money if you buy the dip here. And the average gain is roughly 0.78% within the next 5 days. And the biggest 5-day return is roughly 13.17%. And the biggest loss within the next 5 days is negative 13%. So whether you should buy the dip, you may ask this question, but personally, I wouldn't buy it. Why? Because I don't have the conviction. If the win rate of this strategy improves to 80%, then yeah, that's pretty high chance. Then I'll risk some money and buy the dip here. But right now it's only 75%. So if we change the parameter, let's say if the RSI is below 25, if I run this program again, you'll see that the probability of a bounce is much higher. It's now 77%, close to 80%. Then in this case, yeah, I'll try to play the bounce because the probability is higher. But right now, the RSI is just right below 29.5, so I wouldn't. So the win rate is not that high, so I wouldn't risk personally. But I do think the probability of a bounce is pretty high. But whether you should play the bounce, it's totally up to you. But for me, I wouldn't play it. That's just me. Okay, anyway, let's move on to the next slide. So for this slide, this chart, I show you the relative performance of S&P 500 during all the midterm election years, during the period September to November, because we know the midterm election happens in November, and right now we are in October. We are in the late September, and soon we will be in October. So I want to look at the relative performances during these kind of periods. Usually from this, it may look a bit messy, but anyway, the conclusion is that except 1994 and 2018, the returns are usually positive during October from the historical point of view. But we know that 2022 may be an anomaly. The macro is different this year, so it could be more like 2018 rather than other years. But anyways, this is just another piece of information I provide for your trading and investing decision. So that's it for this slide. And then let's move on to another topic. So the topic for this is looking at the weekly chart technical analysis for S&P 500. So if we switch to weekly chart, you could see that the weekly RSI is still way above 25, and if you do some backtesting, you would see that for every bear market in the past, its weekly RSI always hit below 25. If you don't trust me, just do the backtest yourself. Like for example, for the COVID bear market, the RSI hit 20 or 21, and for the financial crisis bear market, it hit the lowest of 16, and for the dot-com bubble, the RSI hit at least 20. And then that's not even the bottom. The bottom is a few weeks later. But anyway, one of the necessary condition for the bear market to see the bottom is when RSI below at least 25. So if you still don't trust me, just do the backtest yourself, and you will be convinced, at least from the historical data. So that's the first point I want to talk about. So right now, weekly RSI is still so high, right? It's still like at 38. So that means very high chances that we haven't seen the bottom yet for this bear market. And second, if we look at the VIX, let's look at the VIX. Usually for bear market to bottom, VIX has to be above 45 or way up, or even way above 45. So for example, for the COVID bear market, it's way above 80, and for the 2008 bear market, it's almost hitting 100. So that's quite extreme, right? And for the dot-com bubble, its VIX is also above 45. So the second necessary condition for the bear market bottom is VIX has to be above 45. So we haven't seen this condition being satisfied yet. So it's pretty obvious to see that this bear market hasn't bottomed at all. So that's the first 2 points I want to talk about, and then let's look back at the weekly chart, and then this time let's use the Fibonacci retracement to tell us what the key levels are. So let's use the Fibonacci retracement. So from here, from the recent swing low, drag it to the recent swing high. Now we could see that the 50% Fibonacci retracement level is roughly 3,500 or 3,520 to be exact. So I personally think we can see a massive rally once we hit 3,500. However, if you look at the 61.8% Fibonacci retracement level, it's roughly 3,200. So I do think the true bottom may be 3,200 or even 3,000. That's what my opinion is. So that's all for the weekly technical analysis. I don't want to talk too much about it because I want to talk more about the remaining stuff, the remaining interesting stuff. So let's move on to the final part of today's topics, which is about the bond yields, the bond market. So I want to talk about the bond market. That's because I think there could be lots of money to be made if we can perfectly predict the top of the bond yield. If you trade futures, you know we can actually trade the bond yield futures, and that's actually a quite lucrative opportunities. So let's look at the 2-year bond yield first. I have to also add the Fed fund rates. And let's switch to a monthly time frame. As you can see from this chart, the 2-year bond yield usually move along with the Fed fund rate. Why? Because the US 2-year bond yield, or US 202Y, it's usually the expectation of the monetary policy. So I should type this here. Because the market always, remember, the financial market always forward looking. It's always forward looking. So the 2-year bond yield is the expectation of the Fed's monetary policy. So in mathematical term, you can write US202Y equals to the expectation of the Fed fund rate, right? In mathematical terms. Sorry, some dogs are barking outside my house. And we could see that empirically they are quite positively correlated, right? So one question I want to ask myself is how to tell how much more the US 2-year bond yield will move higher. So how much higher the US 2-year US bond yield will move. So to look at this, I run a simple linear regression because we know this is the expectation of the Fed fund rate. So we could just look at using simple OLS linear regression to look at it. So I took the monthly data from the Federal Reserve website, and I run the simple linear regression on Python, and I'll show you guys the results. Okay, here are the results. So you can see the constant is 0.482, and it is significant, and the independent variable Fed fund rate has a coefficient of 1.0045, and it's also significant, and the R square is very high. It's roughly 96%. So we have this. Basically, we can write their empirical relationship in this kind of equation, right? So from this week's FOMC, if we look at the dot plot, we know that the median target by the FOMC committee is roughly 4.4% by year end and 4.6% next year. So based on this, if x is equal to 4.4, let's say 4.4, so we put 4.4, we plug this number into this formula. So we can calculate the expected or the predicted US 02Y is equal to 0.45 plus 1.0045 times 4.4, which will give us 4.87%. So now we have a target for the 2-year yield. So that means if the market really truly prices in this 4.4% Fed fund rate expectation, the US 02Y will move to 4.8 to 4.9% range, roughly, because this is just estimation. It may not be accurate, right? So it will move to this range roughly if the market really tries to price in this expectation and this expectation. So that's one way to look at it from the magnitude perspective. Okay, that's just the magnitude. What about the time perspective? So if we look at the time perspective, you can see that the 2-year bond yield is usually leading the Fed fund rate. if you look at this, around 2018, the US 2-year yield actually peaked around October, but the Fed fund rate actually peaked later, three months later, in January 2019. So that's another conclusion from the time perspective. The US 02Y usually peaks 1 to 3 months before the Fed fund rate. So what does that imply? So if the Fed stops hiking in, let's say, March, because that's what the last FOMC hinting. So based on the FOMC's hints, Fed may stop hiking in March, right? So the 2-year bond yield may reach its peak in December or early January 2023. So that's my prediction for the 2-year bond yield. Okay, so that's it for 2-year bond yield. But what about the 10-year yield? So for 10-year yield, it's a bit more complicated because for the 10-year yield, it doesn't only capture the monetary policy. It also captures the. It also reflects the economic the economy's well-being for United States. So let's look at the. Let's look at this. So we need another indicator other than the Fed fund rate. We need to look at also the unemployment rate. And as you can see, the 10-year bond yield usually is usually within the band. So the unemployment rate usually serve as kind of like an upper band for the 10-year yield, and the Fed fund rate usually served as the lower band for the 10-year yield. And usually when the unemployment rate starts picking up, the 10-year yield usually will start going down. So there are two kinds of forces theoretically influencing the 10-year yield. So the first is the Fed's monetary policy. The second force is the well-being of economy. In this case, I use the unemployment rate as one of the indicator to tell us how good the economy is. Right now, the American economy is still doing fine. The unemployment rate hasn't gone up much yet. But at the same time, the Fed fund rate is going up at a very fast speed. So in order to incorporate both variable into one variable, I divide the Fed fund rate by unemployment rate, and then I do a regression, and then I got these results. This is the fitted equation. So we can basically make two conclusions. First, if this variable is rising faster, if the Fed fund rate is rising much faster than the unemployment rate, then this part will keep going up, right? If this part keep going up, then the 10-year yield will keep going up, right? So the first conclusion is that if the Fed's pace of rate hike is faster than the rise of unemployment rate, then the 10-year yield will still keep rising. And I think that's pretty much the case, because if you look at the unemployment rate, so right now you could see the unemployment rate for August is roughly 3.7%. It's 0.2% higher than the July number. So if it keeps going just 0.2% for the next 3 months, it will only go up like 0.6%, right? But the Fed will hike 100 basis points in the remaining 3 months. So employment rate roughly will go up by maybe 0.6% in the next 3 months. But the Fed fund rate will go up 100 basis points, aka 1%. So in this case, the 10-year yield will also continue to go up, but it will move slower than the 2-year yield because the economy is just starting to go down, but it's at a relatively slow pace compared to the Fed's rate hike speed. So that's one of the conclusions. So I think the 10-year yield will also continue to go up, even though it will go up slower. It will move up slower than the 2-year yield. And the second conclusion is that the 10-year yield also usually peaks around 1 to 3 months before the Fed fund rate, just like the 2-year yield. If you look at the chart, you can also tell it's also leading the Fed fund rate because it's also in some sort of expectation of the Fed fund rate, except that it also incorporates the some macro factors. So that's all I want to talk about the US bond market. So if we can time the top of the bond yield, we could make lots of money, especially if you trade futures. But even if you don't trade futures, you could look at TLT, because TLT is basically 20-year bond yield, right? So, and for the 20-year bond, it usually behaves like the 10-year bond. It doesn't it usually looks very similar, their movement. So if the 10-year yield really peaks around, let's say December, I would say the best time to buy TLT is probably November. You may back hold for maybe another month, but I would say that's a perfect time to start accumulate TLT. Why? If you look at how it does in recession, let's make a recession indicator. So during the recession, let's say the COVID recession, it's up a lot. Like this part, it's up roughly 30%, I think, roughly 30% during the COVID recession. And if you look at the 2008 recession, it was up like almost 40%, I think. Yeah, roughly 30%. So that's a pretty good opportunity. Even if you don't trade future, you could buy TLT when it starts bottom. And my prediction is TLT may bottom roughly in December. That's just my prediction. So please take it with grain of salt. Whether you make your trading decision or investing decision based on this, it's totally up to you. I could be very wrong, but that's my prediction. Okay, so that's all for today. And thank you for watching my video. And if you like my content, please don't forget to give me a like and subscribe. I'll see you guys next weekend. Okay, bye.